So there is some money available, but it's not all the money available. It's not traditional. And in the past, we draw this at our law firm just to sort of outline what the ecosystem looks like. For those of you who know Tony Belletti or have been to some of those things, you hear the word ecosystem and what it fits. It's defined a little different from everybody, but if you take a picture of what the market for tech looks like and you try and fit it on one page, it's generalized, but you see sort of all of the different lines and how they filter in and how important startup companies are. But important to startup companies are venture capital firms and angel investors and other sources of money. And as I said, those things are very tough right now. And it's important as an entrepreneur to see just how tough they are in order to make a plan that actually works to get you some money. So here's an example of just where we were in venture capital. This is for those of you who were here in Ottawa in the late 90s and early 2000s. This is 2001. This is the first quarter venture capital statistics. And we had rounds as big as 92. We had about $375 million invested in venture capital in Ottawa in the first quarter of 2001. This is the first 2 quarters of 2010. We have 4 deals in Ottawa, that's it. And we had 1.75 million in the first quarter. In the second quarter, we had a little bit better activity, 12.2 million. So it does go with the economy, but it is important to understand sort of what the future of venture capital is, because when you build your business, you really have to see where you're going to get the funding. And if you're chasing funding that isn't there, you're wasting a lot of time and effort. So there's really 3 reasons why VC is broken, and if I leave you with anything, it's not to chase money that isn't there. Venture capital, if you look at the 10-year look back, when I showed you 2001, there was a lot of investments made. But the exit history, they look back about 10 years, and there hasn't been that many big exits. There is really very little venture capital. But what is there? Where is there money? There is money still in the angel community. There is still an active angel community, and in our client base, we're seeing some angel financings, particularly, as I mentioned, in Waterloo and some in Vancouver. Those are 2 very hot angel markets. The SHRED program is one most of you probably know, and I assume most of you know about the SHRED program. Ottawa's got a very high take-up of SHRED, but amazingly, there's only 11,000 claims processed every year, as of the last statistics, which was a few years ago. So not everyone is taking advantage of the SHRED program, and if you're not, you should be. You can set up for it and you can take advantage of it. And for the most part, if you're starting out and you're what's called a Canadian-controlled private corporation, which means no more than 50% owned by a foreign entity or a public entity, you can take advantage of something called the refundable tax credit. That is a check. Federally, it's 35%, and provincially, you can go higher than that. It's a check. It's not a tax deduction. It's a check for CCPC companies that will pay some of the cost of your R&D, a percentage of your cost of R&D. What's R&D? Well, for the 35%, you get generally up to $3 million of eligible expenses, which was increased. And so that really means you can qualify, if you're fully qualified, for up to about $1 million a year in cash refunds. And it also allows now, as of 2008, some coverage for activities performed outside of Canada. So for those of you who are using outsourcing or consultants, there is a provision to get some of that covered by SHRED. And the real basis behind the SHRED program is really to try and get R&D activity in Canada. There's no ownership requirement for the IP to be in Canada. You just have to have it through a taxable Canadian entity, preferably a CCPC, and the R&D itself is done in Canada or with limited exception outside of Canada from a Canadian company. So the key objectives in setting up a corporation is, obviously protect your personal assets if you can. Some people start out as a sole proprietorship. They do that so they can write off maybe their garage-based activities against their income from another source. But eventually, if you actually start selling, you're going to want to protect your personal assets from somebody, a claim or something goes wrong. Having a corporation in place limits the personal liability. It's one of the primary reasons why people incorporate. If you do start as a sole proprietorship, or that's how you're organized now, you will have to at some point move the IP assets out of your own name and into the corporation. It's important to do that right, and when you do that, you might want to seek some advice, certainly accounting and tax advice and legal advice. The corporation, the sole proprietorship, partnership, and trust, it's just important to say, that is you. I mean, you can put a name on it, you can go get a business name, but that is you. That is you behind it. You don't separate your taxes, you don't separate your, a trust is a little bit different, but you don't separate the legal liability from yourself. With a corporation you do. It's important to know that, and you have limited liability. Who are the players in a corporation? Just real quickly, again, basic stuff, but a lot of people forget this. They wear different hats, especially in small companies where they may wear all the hats. The shareholders are the owners. They elect the directors. That's their primary responsibility in the management of the corporation, is to elect the board. And they approve, in some cases through shareholders' agreements, major changes through the statute. If there's an amendment to the articles or an amalgamation or a sale, the shareholders get back involved and approve it. But the shareholders primarily are the owners of the business, and most of the management decisions they'll make is just electing the board. Directors manage the business and affairs of the corporation at a macro level. They approve major decisions and they appoint the officers. The officers run the day-to-day of the business. And again, you may wear all these hats at the beginning, but eventually if the corporation grows, they'll separate. The president reports to the board of directors. The directors report to the shareholders in the form of an annual meeting. And the auditors, generally, unless all the shareholders consent not to have an audit, you have to have an audit. So there's an auditor role. And that's the major rules in the corporation. It's pretty simple and again, pretty basic. Incorporating is pretty easy. Most of you have done it, I'm sure. Essentially, you need a few things, including bylaws, articles, and a corporate name. The rules are a little different between Ontario and federally, but essentially, as long as you have a clear corporate name and you have articles which contain the rights of the shares, the rights of the various classes of shares you have, then you're fine. The qualified small business corporation is like a CCPC essentially. Generally, if you're a CCPC or a Canadian Controlled Private Corporation, you're generally a small business corporation. You just have to have most of the assets of the corporation actively used in the business, and you have to be a Canadian Controlled Private Corporation, and there's a holding period for 2 years. If you hold the shares for 2 years, and you get most of your business is active, and you don't have a lot of other stuff like land or things in there, which most tech companies don't, you're going to qualify for the small gains. You're going to qualify as a qualified small business and get the capital gains deduction. Now, just real quick, to finish off, I thought I'd just talk a little bit about issuing shares, because again, this is something that entrepreneurs often get wrong when they try and do it themselves. It's quite easy, because if you issue shares to yourself, you actually are an exempt investor. So generally, when investors invest in shares of the company, it's called a private placement in the legal terms, and it's generally without an exemption from an exemption under the securities laws. You have to issue a prospectus and work through a registered agent. But if there's an exemption, you can do it directly, and it's very, very easy. Most investments in early stage private companies are exempt, and there's a number of exemptions. But it's important to know that there's a broad definition of what a security is, and you have to follow the Securities Act, and that's what we as lawyers think about when you bring a deal to us. Just real quick, what are the exemptions, and what is the prospectus requirement and dealer requirement? Prospectus is essentially a very significant document that you prepare. It costs a lot of money. Distribution, when it is a trade in some security or a sale of shares, you would have to work through an agent unless you have an exemption. So that's what it looks like from a pictorial point of view. If you can stay within the box, you can do it yourself, or have it done very cheaply. If you go outside the box, then you need a prospectus. We as lawyers and you as entrepreneurs want to stay within the box as long as you can. It's way cheaper and way easier to raise capital.